manufacturing slump deepens in May, rising pressure for economic stimulus. Beijing, China's manufacturing sector contracted for the second consecutive month in May, according to official data released on Saturday, casting renewed doubts on the strength of the nation's post-pandemic economic recovery. The figures underscore mounting challenges for Beijing's policymakers amid a prolonged trade war with the United States and tepid global demand. The official Purchasing Managers Index registered at 49.5 for May, slightly up from April's 49.0, yet still below the key 50 mark that separates expansion from contraction. The reading aligned with forecasts in a Reuters poll, but failed to offer reassurance about a rebound in industrial activity. The sustained contraction indicates that Chinese factories are still struggling with weaker overseas orders, high input costs, and a cautious domestic consumer base. Economists suggest that a reading under 50 for 2 straight months signals more than just a seasonal dip. It reflects underlying structural strains in the manufacturing sector. The PMI release comes at a time when China's broader economic momentum is being sapped by precedent US-China trade tensions, which continue to disrupt supply chains and dampen investor confidence. The enduring trade conflict, coupled with global monetary tightening and rising geopolitical uncertainty, has led to a cooling in export growth, a traditional pillar for China's economy. Domestic pressures are also intensifying. Despite government efforts to boost consumption and ease credit conditions, consumer sentiment remains muted. Small and medium-sized enterprises in particular are bearing the brunt of falling orders and shrinking margins. Economists and analysts now anticipate that Beijing may be compelled to roll out additional stimulus measures to stabilize the industrial sector and sustain overall economic growth. Potential steps include further interest rate cuts, increased infrastructure investment, and more targeted fiscal support for vulnerable sectors. However, policymakers are walking in a tightrope. While stimulus could reinvigorate short-term demand, it also risks exacerbating debt levels and assets bubbles in an already fragile financial system. With the PMI languishing in contradictory territory, global markets will be closely watching Beijing's next move. A third consecutive month of contraction would likely trigger more aggressive intervention and possibly a recalibration of China's growth targets for 2025. For now, the May PMI acts as a red flag, not just for China's factories, but for global supply chains and investors banking on Chinese recovery to buoy worldwide economic momentum.